I would like to introduce Professor Tom Boss to moderate our first Business International Tax panel.
Thank you very much. Well, thanks for coming back from lunch. I think that we have a rich afternoon in store for us. I'm just delighted to introduce this first panel on business and international tax issues. This is a pretty business-heavy session here in this first afternoon session. Our speakers are Professor Stephen Bank, Vice Dean and Professor of Law at the UCLA School of Law. He has taught a variety of tax subjects, practically the entire curriculum in that area. His research generally explores the taxation of business entities through the lens of law, of legal and business history. Professor Karen Burke is the Warren Distinguished Professor of Law at the University of San Diego School of Law, and she is now a visiting professor at the Florida University Levin School, a College of Law in Florida, obviously. Our third speaker is Martin Sullivan, the Chief Economist of Tax Analysts. He has been the Chief Economist for Tax Analysts daily and weekly publications and blog, is an expert on federal tax reform, written 2 books on tax reform. Frequently makes media appearances. Our commentator will be Michael Schlier, who's a partner at Cravath, Swaine & Moore in New York. Michael is a tax partner, practices in the area of mergers and acquisitions, corporate tax, international tax, consolidated returns, and financial products. Is in past chair of the New York State Bar Association tax section, among many other honors and responsibilities. So the order of engagement is each of our primary speakers will speak for 15 minutes. Mr. Schlier, as commentator, has 12 minutes, and the remaining 18 minutes is for you. And so we hope that you will feel free to ask your questions. And I will, my job, by the way, when you ask a question is to try to repeat it so that our worldwide audience, in real time, our worldwide audience will, in fact, hear the question so that the answer will be more intelligible. So I first would like to introduce Mr. Bank, Professor Bank.
Thank you, Tom. And I want to add my thanks to Pepperdine, to Paul Karen, to Tax Analysts for having us here, and also be the first to thank David Cay Johnston for always entertaining talk, although I, for one, would have been also entertained if he had given us a little of a Syracuse class on ancient tax history. Maybe we'll have to get that in the evening. So today I wanted to look at corporate tax reform with a broader lens, taking seriously the topic, the theme of this conference, advice for the second Obama administration, although I have to say that I may not be the best messenger because I did have an opportunity once. Valerie Jarrett was the graduation speaker at UCLA, and I was, being vice dean, was able to speak at her table, and she legitimately sat down and said, what I need to know is what we can go back and do about international tax. What can you tell me? So I gave her something, some version of this, and obviously it didn't go anywhere, so I'm not so sure that in the second Obama administration I'm going to do any better. Nevertheless, I don't think what I'm saying is all that controversial. It just hasn't been said probably enough, so it deserves repeating. As many of you know, one of the major themes of the last 30 years, probably or more, is the growth of multinational corporations. There's a lot of metrics by which you can judge this. The growth in corporate profits from 2006 to 2011 is primarily offshore. The number of corporations filing returns who have also multinational or international income is about half now. It's fairly clear that we've entered an era in which, as Mihir Desai, a Harvard Business School professor, calls it, the decentering of the modern business corporation. That is, the corporation no longer can be attributed to any one particular jurisdiction. It It often has multiple spots, multiple loci of activity, of operations, and that makes it a challenge for a corporate tax system. And not surprisingly, in the U.S., the corporate tax has suffered in part because of this decentering of the business corporation. So, for example, corporate tax receipts as a share of profits were only at about 12.1% in 2011, compared with 25.6% on average between 1987 and 2008. Moreover, the U.S. Seems to be particularly hurt by this in the sense that the U.S. now collects less in corporate tax revenue as a share of GDP than most other OECD nations. So, not surprisingly, there has been a call for tax reform focused on the taxation of corporations, U.S. corporations earning income abroad. You see that in Obama's February 2012 framework for business tax reform. Most recently, in January 2013, the CBO released a report describing possible options for taxing the multinational corporation. It is something that is on the agenda. How do we do it? The problem with it is that most of it is focused domestically and inward. That is, what is the problem in the U.S.? What's going on here that is structurally or otherwise that is impeding our ability to operate? And a lot of the impetus for reform is competitive. That is, it's based on competition, the theory being that something about the U.S. tax system that is driving U.S. corporations abroad and that is inhibiting our ability to collect taxes. So it's both bad for U.S. corporations and bad for the U.S. government and the U.S. revenues, and that this is a problem we need to remedy, we meaning the U.S. But there's another way to think about this problem. It still could be thought of in a competition sense, but it's not really a competition among U.S. corporations and non-U.S. corporations. It's really between corporations, generally speaking, and governments. That is, the issue is not that formerly U.S. corporations are now paying French tax, or they're paying taxes to other countries instead of paying it to us. It's that they're not paying taxes anywhere. They've found a way to shift the profits to non-tax jurisdictions, to shift it offshore completely. And so if you think about the problem as profit shifting, and then you want to know how do we address these concerns in a purely domestic way? And as you know, others have stated, in fact, David Cay Johnston in his lunchtime talk referenced Ed Kleinbard's article on stateless income. The system is such that if no one is collecting the tax, if the corporation is located nowhere, then it's not a U.S. problem, it's a worldwide problem, it's a global problem, a problem that we need to look at from a worldwide perspective. One particularly apt illustration of this is the fairly well-known by now a scheme, the double Irish-Dutch sandwich transaction, which clearly involves a lot of countries and involves exposing or leveraging different definitions in those countries. So in a simple description of the transaction, this type of scheme, which has been used heavily in the high-tech industry because of the ability to shift income from IP rights, intellectual property rights. So Apple and Google and Facebook and others are reported to have used it. What happens? The U.S. is shifting their licensing their rights over to Ireland, which has a 12.5% corporate rate as opposed to the 35% top rate in the U.S. Then Ireland sets up a subsidiary. The subsidiary is located in Bermuda, but it is an Irish company. And why do you do that? Well, that's exploiting the difference between the definition of a tax resident. So in the U.S., it's a corporation so in the U.S., it's an Irish corporation, but in Ireland, they use the managed and controlled criteria. So in Ireland, it's a Bermuda corporation. And then that subsidiary, which owns now the IP licensing rights, license it to the Irish parent, the Irish company that is using that to make products worldwide, right? To build products, to do the work in Ireland. So there's actual work being done in Ireland. But then when the Irish company wants to pay the now Bermuda company it would have Irish withholding tax, so they take advantage of the European Union exemption, that is the exemption for taxes paid or money flowing to other EU countries, so it goes to the Netherlands, that's the Dutch part of the Dutch sandwich, and then filtered through the Netherlands, it gets over to Bermuda. So the bottom line is it's not, the problem is not that Ireland has a 12.5% rate, it's that there's Bermuda, which doesn't tax it at all, and so you've got 4 countries involved. You've got the US, you've got Ireland, you've got the Netherlands, you've got Bermuda. You've got different definitions of where the corporation is sourcing their income, where it's a resident. You're taking advantage of international organizations, the EU, and what exemptions are available within EU nations versus non-EU nations that's specific to Ireland. And in this kind of scenario, you really don't have the ability to say if the US simply changed something, the whole world would change. You've got to think about this as being a broader problem. Moreover, you've got to think about this as not just a US problem. It's not only the US that's taking advantage of it. The UK, there were reports in the fall, the UK was very concerned about British companies that were taking advantage of Ireland's lower rate, but not just Ireland's lower rate, taking advantage of the use of Ireland to get to places like Bermuda. So this is where Ed Kleinbard, who also wrote the Stateless Income, maintained that the tax avoidance strategy used by Apple and other multinationals doesn't just minimize the company's US taxes, it minimizes their German tax, French tax, and tax in the UK and elsewhere. So in this scheme, the question is, what do we do, right? What do we do? Is the US going to be enough to do it? And clearly not. My argument is that international cooperation should be part of the conversation, or at least we should be aware of the international cooperation that's already going on. So in the paper, I detail a number of ways in which corporate tax reform is a global phenomenon, that it is not simply something that is a US issue, but it is a worldwide issue. There's a growing influence over the last 20 years of European organizations, the European Union, the European Court of Justice. I'm clearly not the first person to talk about these. Plenty of people in this room have talked about Michael Graetz and Ruben Abiona and others. A variety of top-down mechanisms by which they have imposed kind of a corporate tax harmonization theme to member states. You've got, even in the European Commission, you've got early proposals for explicit corporate tax rate harmonization. A code of conduct on business taxation was developed. All of these things are Europe primarily, but they put competitive pressure on the US. And that's really the second part of this argument. One, we can't do it alone. But two, if we do it alone, or if we do nothing, our US corporations are going to face the effects of the multinational corporation that's already going on. So it's not really anymore a situation where we can decide to cooperate. It's a situation where how do we grapple with the cooperation that's taking place. So 2 recent reform proposals give you an idea of where things are heading. So the OECD in November of 2012 released information on a base erosion and profit shifting project where their hope is to harmonize entity and hybrid instrument characterization to try to provide some homogenation of that, to deal with the different standards for anti-avoidance measures, to deal with intergroup transactions. These are things that are not talking about rates per se, but are just as important if we're thinking about competition. If they're making changes in Europe or elsewhere and we're not, that also will produce potential problems for us. Another similar project in the European Commission was released in December 2012 for corporate tax fraud and tax evasion, designed to deal with creating standards for good governance in tax and also on the anti-avoidance measures, proposing actual penalties or trying to enforce on third parties that don't adopt their standards. So the question then is can we act unilaterally? I think the answer is no. But I don't want to say that the answer is that we have to cede our territory over sovereignty over our domestic tax policy. Alison Christians in the next panel is going to talk a lot about that, and I think she's right that there's a place for this, but I think that we have to think in a global sense about what cooperative measures are already taking place in order for any domestic tax initiatives to have any value. So, for example, if we think about the Dutch the Dutch sandwich problem, the double Irish transaction, the U.S. can do all they want in reforming from worldwide to territorial, but if we don't address the differences between our definition of where a corporation is located, then the corporations are going to be able to exploit that difference to their advantage. So it's not clear that we have to do what everybody else does, but we certainly have to be mindful of it when we do whatever tax reform we're proposing. So let me conclude by saying that what I think is a modest contribution, but one that, again, has not been said enough in the current tax reform discussion on the international side. This is less about the fact that we have a lack of about our normative justification for cooperation. There's a whole literature, not yet in the paper, but I'll probably put it in just to recognize that it's there. There's about the normative justifications for international tax cooperation. I just think we've moved past that to the point about the inevitability of the influence of international cooperation and how if we don't get into the game, our own unilateral efforts are going to fall on their face. So it is one of those scenarios where the U.S. is not being a leader, but it can be a leader, can be part of the conversation better, and in our own efforts we can achieve more of our own domestic goals if we're at least aware of and participate in these broader international mechanisms. Thank you very much.
Thank you.
Okay, my paper is pass-through entities, the missing element in business tax reform. And I'm tempted to call them the elephant in the room. We've heard a lot about a possible consensus on how we ought to reform our business tax system. President Obama has suggested 28%, Mitt Romney suggested 25%. So the notion is that everybody thinks we should lower the corporate tax rates in order to improve competitiveness, a term that's asserted and seldom or nowhere defined. See? And we should do that by eliminating tax expenditures. So which expenditures are we going to eliminate? We're going to eliminate, if we eliminate all of them, starting with accelerated depreciation for corporations, we can get the tax rate down a couple of percentage points, nowhere near 25, nowhere near 28, and let alone 25. So I brought with me, picked up today, the Tax News article, and I advise you all to look at the article that says, Tax Reform 2013, What Price for a Corporate Rate Reduction? Because what that article says is reducing tax expenditures would be the worst possible way to pay for a corporate rate reduction because, it would inhibit investment. A lot of these are temporary. They reverse like accelerated depreciation. So how do we get to corporate tax reform? How do we get to those low rates? Well, let's get out of the static trap of revenue neutrality. Let's think about dynamic scoring, and then we can do it. What I'd like to say is that to the extent that tax reform must be bought, and to the extent that we are agreed that the corporate rates must go down, if we're agreed to that, then what we have to realize is this is not 1986. In 1986, we shifted income. We put a higher burden on corporations, in part to pay for individual low rates. Now what we've got to do is to have the pass-through sector subsidize a reduction in corporate tax rates. Because it's really not about corporate tax reform. It's maybe not even about business tax reform. It's about individual tax reform. After the 1986 Act, we shifted through self-help integration to pass-through entities, and today this should be a shocking percentage. Today, over 50% of net business income comes from pass-throughs. The corporate tax used to account for 30% of revenue in the 1950s. It now accounts for something less than 10%. So if you're going to go where the money is, you're going to have to look at pass-throughs. And pass-throughs are already loudly complaining. They're saying you're getting rid of business tax expenditures, but we use those. And you're giving the corporations a lower rate. But what about us? Okay? And next you're going to hear, and you heard this in the run-ups to the election, taxing pass-throughs would ruin small business. If you eliminated if you allowed the two top rates to revert to what they were prior to 2003, the Democrats said that affects 3% of small businesses. The Republicans said it affects 70% of small business income. Why? Both are true. Why? Because there are large partnerships. And what do you think is large? Well, partnerships with over 100 million of assets account for 0.6% of all partnerships, but 72% of all partnership assets. And guess who earns pass-through income? It's predominantly earned by higher income individuals. So I think that we have to realize that yes, if we're going to lower the corporate tax rates, somebody's got to subsidize it. And there's another problem with our pass-through system, and we're very lucky to have had David Miller and Mike Schler here today. Our pass-through system is a complete mess. And I'm a partnership tax person. Why is it a complete mess? Well, you had those wonderful subchapter S corporations that we all thought would go extinct after the 1986 Act because there was no longer any role for them. In fact, they tripled. They went from 4% of all businesses to 12.6%. Why? Because they have a special employment tax benefit. They can get out of paying the employment tax under the standard of reasonable compensation. It's hard to litigate, isn't it? And the CBO estimated that there was $23.8 billion of S corporation under compensation in 2003. What do you think that does? When you think about Social Security and Medicare, and about these taxes contributing to that, if there are whole sectors where you simply don't pay the taxes, then we're going to erode that system faster. So when we talk about maybe cutting or reforming Social Security and Medicare, let's talk about employment tax, scofflaws. But it's worse than that, because it's not just scofflaws. It is that we have so many different entities, we don't know how to apply the standards to them. Who's a limited partner? You would have thought that was an easy one. I don't know. The courts are beginning to address it. And now we have another wonderful thing, which is the 1411 tax, which some people refer to as the Obamacare health tax, 3.8%. But if I'm an S corporation shareholder, I can avoid that as well as my employment taxes. Now, what do we do when we reduce the corporate tax rate? We get it down to 25%. Have we now created a giant shelter? What am I going to do if my taxes are 40%? I'm going to stuff my capital and labor into my corporation and hope to get it out. Ed McCaffrey, I'm going to hope to get it out at death with a stepped-up basis. So I'm all for repealing the stepped-up basis, which would help in addressing some of this situation. And then there's the disgrace of closely held corporations. Why does anybody need a closely held corporation? Who goes into them? Well, you need the benefit of the two low brackets. And you're a high-income earner, but form your close corporation. And I won't spend any real time talking about publicly traded partnerships and entity classification, but that's where it really gets fun. Why? Well, because after the 1986 Act, we enacted 7704, and we said a publicly traded partnership is taxed as a corporation. Well, we're smarter than that now. We can create blocker corporations to change the character of income from active to passive and to make sure that I've got a publicly traded partnership that's respected as a partnership. So the dividing line between public trading and not publicly traded is extraordinarily porous. And we think that using a blocker corporation in order to undermine what was the intended character of the income is your elective choice, not subject to the economic substance doctrine. I think that's right.
That's right.
Yeah, it is right. Okay. But it's wrong.
You're right.
Okay. And when I was on the ALI project in 1999, George Yin was the chair of that, and we went down a path of so-called pay life and so forth. It was really almost, I wouldn't say we were led astray, but we asked the question, are there abuses out in the 704 regulations that we should be aware of? Because we had some of the very best practitioners with us. And we were told, no, they're working just right. Well, those cases have now been litigated. They weren't working just right, but people by and large got away with it. So in the ALI project, we said it was a close call between perfecting the pass-through system and having not a double tax, but a single tax at the entity level. We said that was a close choice. I think it's clear now. It's no longer a close choice. There is no way to perfect the pass-through system. And if you don't believe me, because I'm just an academic, you should take a look at a 160-page letter that Terence Cuff, Loeb and Loeb, if he's listening, that Terence Cuff wrote to the Treasury, saying that things like target allocations, securities aggregation, they really, truly shouldn't work. Okay? Now, is there any path forward out of this? What's the advice to the Obama administration? And I'm awfully glad it's advice to the Obama administration. Mine is, while everybody has criticized what happened in the Cliff negotiations, don't be premature. Because we've got capital gains and dividends up to 20%. You want a reduction in the corporate rate to 28? Put capital gains and dividends up another 25%. And I wouldn't mind, and I think that Mike Graetz has advocated this long before I got to see it, 25, 25. 25 corporate tax rate, 25 dividends and capital gains. That's not a bad way to go, because you could prevent, as long as you have the combined corporate shareholder burden at least roughly equal to the maximum individual rate, you can prevent your corporations from becoming massive tax shelters. If you allow expensing, which is what's being advocated in that tax notes article, expensing in the US plus zero overseas, that's a massive tax shelter. So I think 25-25 looks good. And I also think if you reduce the corporate tax rate, that is regressive, though we could argue about how regressive it is. But increasing the capital gain and dividend rate is progressive. And the combination of those two rate changes is progressive. And since I should have realized that I was really supposed to be talking about international tax, let me say, I still think I would have started here, because you can't really form a view of international tax reform unless you know the contours of business tax reform, including corporate tax rates and the relationship between corporate taxation and pass-through taxation. Thank you.
It's great to be here this afternoon. I'll thank the students of law school here at Pepperdine for all coming to listen to us. It's a great honor. Since the title of this conference is Suggestions, Recommendations to the Obama Administration, I thought I'd take a crack at making a proposal, not something I normally do. And it's something I discovered during writing some articles for tax notes, and I'm very excited about this proposal because I think it has a lot of merit. Of course, I could be wrong, so I want you all to give me lots of critical commentary, and I know it won't be in short supply. For those of you who don't live and breathe international tax, I'll give you a little background. The title of this The title of this is The Treatment of Interest in International Tax, which sounds like a very boring detail, and of course it can be very boring, but it is not a detail in the great debate on where we're going with international tax. It's a very central component of how we will be treating our multinationals in the future. So don't be put off by the title. Okay. The rest of the world, most other major countries have a territorial system. Canada, Australia, France, Germany, all the big countries. And most importantly, Japan and UK in 2009 moved to a territorial system. What is a territorial system? In plain English, all your foreign income is exempt from U.S. tax. A territorial system has been part of the Romney Plan, of the Ryan Plan, and most importantly, of the plan by Ways and Means Committee Chairman Dave Camp. It has also gotten a lot of visibility from the deficit commissions, the deficit committees. Bowles-Simpson has a territorial plan, and the Gang of Six, the 6 senators, has a territorial plan. So there's a big groundswell among conservatives and people in the middle of the road for territorial. And let me just say, some of you might be confused because I think there's a fundamental dichotomy in the debate about international tax, which is one day you'll hear, gee, these multinationals like Apple and Google are getting away with murder, and you see proposals from the Obama administration to raise taxes on multinationals, and that's a very large component of the political debate. But simultaneously, when you go to, I go to meetings with business groups, and everybody's talking about reducing international taxes at the exact same time. And I don't know where it's going to end up. So for purposes of today, I'm just going to assume it's somewhere in the middle. But the thing we want to mention is that even Democrats can believe in a territorial system. If you look on page 242 of Woodward's book, Timothy Geithner, who in public does not favor a territorial system, says that he might consider it as part of a negotiation. And why would a Democrat who wants to raise taxes on multinationals consider moving to a territorial system which would exempt all of their foreign profits? That's a good question. The answer to that question is territorial can mean a lot of different things depending on the details. And the details, that's what I'm going to talk about today, is one of those really important details. So if you say you're in favor of a territorial system, you're not really saying whether you're pro-business or anti-business. You're not really saying whether you want to raise revenue or lose revenue, because a territorial system can either raise or lose revenue depending upon the rules that you put in there. And specifically, depending upon what they call the anti-base erosion provisions. So are you going to have a territorial system with teeth? It's tough. that's going to raise, perhaps raise revenue, or are you going to have a toothless, or sometimes called cartoon territoriality, which gives away the store and greatly reduce taxes on multinationals? Whether or not that's going to occur depends on two things, two categories of rules. The first is tougher subpart F rules, or as they call them in Europe, controlled foreign corporation rules. And what these rules do is they sort of set up all types of gates and blockages to prevent profit shifting. You've heard about to prevent aggressive transfer pricing. The other major factor determining whether or not a territorial system is going to be aggressive or be very lax is how interest is treated. And that's the subject of today's talk, so to give you that context. We're talking about a very important detail when we move to a territorial system. Okay. Now, the treatment of interest comes up in two contexts in the territorial system. First, we say we want to measure income properly. And if you think about it for a second, you're exempting foreign income. Well, the matching principle, for all the accountants in the room, the matching principle says, well, if you have exempt income, you shouldn't allow any deductions attributable to that exempt income. So now we want to, in a formal, plain vanilla territorial system, you would not allow interest deductions for income attributable to foreign operations. So that's the first issue. And then you have a separate and related issue of we don't want to allow artificial profit shifting through related party loans. I was just watching, because I'm such an exciting person, I was watching BBC News last night, and there was a whole television show about related party loans between some of their prominent multinationals and their Luxembourg subsidiaries. So again, this is, it sounds very boring, but it is at the center of the debate in the UK right now. And I think if we ever start really talking about territorial, it's going to be the center of the debate here in the United States. So again, we have income measurement, the matching principle, and then we have these thin capitalization rules, which are supposed to block abusive transactions. On October 26, 2011, Dave Camp, the chairman of the Ways and Means Committee, did something that very few people in Washington do. He actually spelled out what his proposal was. Instead of just saying, I want territorial, which you can hear from on any street corner in Washington, he actually laid out a specific plan. And it was a discussion draft with a lot of brackets and parentheses and maybes and so forth, but there were a lot of details in there, and the international tax community's been chewing on them ever since. The two things that he did with respect to that first thing about proper income measurement, on interest allocation, well, he said, I am not going to try to allocate interest. I'm not going to really explicitly deal with it. I am just, as a proxy for not having it, I am just going to disallow the exemption for 5% of foreign income. It's called a 5% haircut. So it's sort of an ad hoc rule, simplification for dealing with what could be a very complicated issue. And then on the thin capitalization piece, which is supposed to prevent abuse from related party transaction, he actually had a pretty complicated rule. He had a two-pronged test where he said this, and I'll try to say it in plain English. He had a debt equity rule, and what the debt equity rule said was, if your debt equity ratio in the United States, if your leverage in the United States is higher than what it is worldwide, that is, you have a disproportionate amount of debt or interest expense in the United States, we're going to disallow it to the extent that it exceeds that excess. And then he also put in another rule, and he put it in brackets, but I'll just say 30%, where if your interest deductions in the United States exceeded 30% of adjusted taxable income being taxable income adding back without including interest expense and depreciation, sort of a cash flow measure, we're going to disallow that. Okay. Now I'm going to tell you why I think he should change all that. And to his credit, he just put that out there to stimulate discussion. And one thing you want to note about Chairman Camp's discussion draft, I think extremely important, is that it's revenue neutral. Politically, I don't know exactly why, but this is a main, I think being a Republican, a pro-business Republican, Dave Camp would like to have a very generous territorial system. However, the powers that be, probably the leadership in the House, said it has to be revenue neutral. So therefore, he has to put a lot of anti-base erosion rules in. And what I like about this is we don't have to get into a big discussion about competitiveness and about whether or not we should have these base erosion rules based on economics. It's just, we just need to have them because we need the revenue. And so I don't have to get into capital export neutrality versus capital import neutrality versus all the other rules. We need to find some way to prevent this base erosion, and let's try to figure out the best way to do that. Okay, observations. At the first hearing of the Ways and Means Committee on this topic of international taxation, Paul Arsterhaus of Skadden, he made the observation, hey, you know, those the interest allocation rule and that thin cap rule, well, they both control interest. You really don't need to have both. And it's one of those things, after you say it, you go, it's obvious. But beforehand, I didn't hear anybody really talking much that way. And so then in an article I wrote last summer for Tax Notes, I did all the math like a good economist should, and I found that in a very generic situation, these rules are exactly the same. And what I mean by that is if you allocate interest by assets, it is the same thing as having a debt equity rule. That is, so basically, if you have too much leverage in the United States, we're going to take some of that away. Okay. If you read the great article by Michael Graetz from 2000, oh, Michael, I didn't see you there. In 2008, that's sort of my starting point. And in this article, Michael shows why using an interest allocation rule is so much better than current law. All these numbers I have up here, I won't walk you through them. I did a plain vanilla example. But under current law, a U.S. multinational is subsidized, in many situations, is subsidized for foreign investment. In my example, the multinational has a negative effective tax rate of minus 2.5%, which actually gives it an advantage over foreign multinationals because a U.S. multinational can deduct its interest at 35%, while foreign multinationals have lower rates. So under current law, U.S. multinationals are advantaged over foreign multinationals. But if you move to if we move to an interest allocation rule, and as Stephen was talking about, you know, we did that. Whether we do it unilaterally or multilaterally is a very big question. But if we did it on a multilateral basis, we would move to a much more neutral system. The foreign versus domestic multinationals would be on a level playing field. There would be no more of those negative effective tax rates. The domestic versus foreign playing field would be much more level. It would be a much better world if we could have a multilateral allocation, a multilateral adoption of interest allocation. But then I took it a step further, and I said, what if we went and did it unilaterally? Well, that is the multinationals are very upset every time you talk about going to a unilateral allocation because that would put us at a competitive disadvantage. And they say that you would be subjecting us to double taxation. And to make a long story short, when they say that, they're assuming that they cannot get the interest deduction anywhere else in the world. And by related party loans, they could put it in any other country that they're operating in. So the claims of double taxation I think are overblown, and I think with a little bit of tax planning, you can almost duplicate what you're getting right now anyway. So I don't think the move to unilateral allocation, unilaterally moving to interest allocation would be that dangerous from a competitive point of view. And finally, I'll just skip along here because I just see I only have a few minutes. I discovered when I was juggling my equations something which I find to be a very interesting possibility, which is instead of allocating interest by assets, which is the normal rule, I'm going to propose allocating interest by gross profit. And by gross profit, I mean profit before interest deductions. And this produces two benefits. First, it's much simpler than allocating by assets. The problem with assets when you measure them, you have to decide whether you're going to do market value or tax basis, and you have to pick a point in time, and then one point in time may not be representative, so you might have to pick multiple points of time. There's a lot of administrative issues with using assets as an allocation factor. Gross profits does not have all of those problems. But the most interesting thing that I found was the effect that it has on the other problem. If you remember back to the second slide, we have a profit shifting problem where transfer pricing is rampant, and we need to stop that if we want to prevent the revenue hemorrhage under a territorial system. If you allocate by gross profit, it creates a very strange, not strange, but a very surprising dynamic, which is, let's just take an example, and just give me 30 more seconds. The example is this. If you shift profit to Ireland now because you're a U.S. pharmaceutical company and you have an Irish subsidiary and you start selling pills back into the United States and you're charging very high prices in order to keep the profit low in the United States and the profit high in Ireland, well, every dollar that you are able to shift by doing that is, you save, the U.S. rate is 35, the Irish rate is 12.5. The difference is, I think it's 22.5. You save 22.5 cents in every dollar that you shift over. However, if we had a rule that, like I'm suggesting, to the extent that you have interest deductions, to the extent that you are leveraged, and the more leveraged that you are, when you shift profit to Ireland, you're going to reduce the amount of interest that you can deduct in the United States. And you get this very cool effect of depending on the amount of leverage you have and depending upon the difference in the tax rates, but under not unreasonable circumstances, you can greatly reduce the incentive for shifting profits. So by adopting this, by adopting the method that I'm suggesting, you would not only be helping the interest allocation rules and simplifying them, you would also be partially solving the problem of profit shifting. So, and it would also be much simpler. So time's up, and thank you very much.
These were all great papers, and let me start with Karen on the domestic side. I totally agree with Karen that the pass-through system is a complete mess. If you work in the area, you see that every day. And it's actually worse than it sounds, because when it's a complete mess, it means taxpayers can take any position they want. At least, whatever the rule was, either way, at least people are bound by it. When you don't know the answer, you do whatever you want. And so that's a real revenue loss to the government. The other thing I agree with that Karen said is that lower corporate rates will certainly make closely held C corporations into a tax shelter. The one thing I disagree with is Karen seems to think that if you make the dividend rate high enough, under 25.25, that will somehow prevent that. But the reality is the reason there'll be tax shelters is that people will keep everything in the corporation and not pay it out as dividends, and then rely on this 10 million exemption to get a step up at death. And so it's really a permanent tax savings that really doesn't depend on the dividend rate at all. Now, you may say, well, but we have, personal holding company tax rules and accumulated earnings tax rules that will prevent all that. But if you look into those sections, you'll see that, and there's a lot of cases on those sections, that they're old cases. People, it's sort of hopeless to think the government will ever win those cases. Accumulated earnings, everybody is planning on buying a building in 5 years and saving up their money. Personal holding company, which is limited to passive income based on gross income. People are buying laundromats where all the income is gross income, and it's just almost like an annuity for the profit. It's no profit, but you bulk up your gross income, and you're not a personal holding company anymore. Another really irrational part of the system is the 7704 test for publicly traded partnerships, which are really designed for really real estate and natural resources. If the company that owns the trucks that delivers oil to your house, door to door, that company could be a publicly traded partnership because it's natural resources. They're delivering oil, just like oil tankers. So it's defined very broadly. Karen, suggests taxing pass-throughs as corporations, large pass-throughs as corporations, which might be a good idea, but one other thing to focus on is REITs, real estate investment trusts. More and more real estate is going into REITs because both the statute has been broadened as to what REITs can do. They used to have to be really passive. Now they can do more and more, and they can have C Corps as subs to be almost like blockers again. And also, there's been articles in the paper recently, operating companies are now talking about taking their real estate, putting it into a sub, spinning it off, and then having the spun off company elect to be a REIT. And so what happens is the old parent pays rent and gets a deduction for the payments to the REIT, and then the REIT is a pass-through, and so you've shifted a lot of corporate income into the pass-through sector. And then that's the wave of the future. So if you want to protect the corporate income tax, you really got to do something about that also. Now, let me talk, several panels have talked about revenue neutrality. You know, revenue neutrality is based on a 10-year budget window. Nobody cares about what happens after that. You know, Ed Kleinbart coined the phrase cartoon territoriality for that reason. I want to be known here as coining the phrase cartoon revenue neutrality because I'm just in the recent tax bill, you know, there's a perfect example of that with Roth IRAs. You know, they need some money now, so what do? You let people pay some tax now even though they save 5 times as much in the future. And so you'd let people convert their 401ks into Roths, and that's a revenue raiser, even though on a long-term basis it's a giant loss to the government. And accelerated depreciation is the same thing. It's basically shifting tax revenues into year 9 from year 11 of the 10-year budget window, and suddenly you make money and you can pay for something else. And you know, even the CAMP proposal that we were talking about for for territoriality, that is supposedly revenue neutral. So how did they get it to be revenue neutral? There's this one-time tax on existing overseas earnings that people are forced to pay tax on over magically 9 years. And the 10th, it's only 9 because you pay tax the following April. You have to get it into the 10 years. And so, you know, there's this one-time revenue windfall, and then what do you do in year 11? You don't have that, but you still have all the tax cuts. And so, you know, that's revenue neutrality. But more generally on domestic reform, even aside from international, you know, the whole idea is to cut back on existing tax incentives to get a lower rate, and you know, in a revenue neutral way, supposedly. You know, so what that means is there are winners and losers. The people that take advantage of a lot of deductions now will lose because they're losing their deductions, and the people that you know, Walmart and that don't get a lot of deductions now, you know, retailers and all, they'll win because they get a lower rate. Because for revenue neutrality, whoever gains is for anybody who gains, somebody loses. So that's by definition. So, and also, if you lower the rate and reduce deductions, what you're really doing is you're giving a windfall to old capital because it's already there and they're getting a lower rate. And you're putting a burden on new capital, like new investment, because, again, if it's revenue neutral, if you're giving a benefit to the old capital, you're hurting new capital by taking away their deductions. So all we're doing is sort of shifting money around in a revenue neutral way, not making any money, maybe losing money in the long run. And is it really worth all the trouble, I would say, to do all that when in the end you haven't made any money and you're just shifting money from one to another? It'll be politically very difficult because the people that are losing guarantee they may not care about revenue neutrality. They care about personal tax increases, just like all tax increases. So, you know, it's not clear to me that this kind of corporate tax reform is likely to pass or is even worth doing.
I'm going to add you to the skeptics list.
That's fine. That's fine. So turning now to you know, Marty Sullivan's paper on this, you know, the 5% tax on 5% of dividends, and I always thought that was intended to cover non-interest expenses like you know, administrative expenses and R&D and that kind of thing, and so you still need that 5% cutback, totally aside from interest. But even more importantly, if you get rid of that 5% cutback, since the whole thing is designed to be revenue neutral, regardless of the reason for the 5%, you got to make it up somewhere else. So you know, it's like squeezing a balloon. You can say, well, that particular part isn't right. We shouldn't charge those people something, and that's fine. But who else? You got to tell me who else you're going to charge instead when you're doing that. So then on, you know, I sort of like the idea of having the disallowance of interest be based on gross profits, but it may not get as much money as you might think, because even now I would have thought, and this is an empirical question, that for a company to shift income offshore, they might have to shift assets offshore also, like intangibles, and so they would have had to lose some more interest expenses anyway. So there may be some benefit, but not as much as you might think at first glance. And the way I'm not sure I agree with the way Maury described the Camp proposal on the interest cutback. The way I read it is that it's only if you lose some interest deductions, only if both your U.S. leverage is more than your worldwide leverage and your interest expense is more than 30%. So the 30% is almost like a de minimis safe harbor. It's not like he was saying if either one of these is bad, you lose. It's only, you get to choose. So if your worldwide interest is really high, as long as it's the same in the U.S., that's okay. Maybe that's the right answer or the wrong answer, but that's the rule. Okay, now turning to Steve Banks, there's a lot of discussion about the U.S. nominal rate and the U.S. effective rate. There were several CBO studies that came out in the past just 2 or 3 weeks that said that the actual effective tax rate in the U.S. is not that different than OECD, even though in form it's a higher marginal rate. And I personally would question whether we really have a higher marginal rate even, and you might say, well, that's crazy, but if companies can eliminate a lot of their income, I mean, the idea is that if you can only eliminate a fixed dollar amount of your income, and then after that you pay 35%, sure, but that's not really how these transactions work. What you're really effectively doing is eliminating a percentage of whatever income you have, and that effectively means the marginal rate on the last dollar of income is, if you're eliminating half your tax, the effective marginal rate is 50% of 35. It's not 35. And finally, on this idea of global cooperation to avoid income shifting to tax havens, I'm not convinced that harmonization will do it, because even if every country had exactly the same tax system we did, I think the real problem is Section 482. And 482 has problems both as a theoretical matter, whether that's really the way to do it, and as a practical matter is, people do what the companies do what they want, and it's very hard to enforce. The government always loses the cases that come to trial. And global cooperation, I don't see how global cooperation will help that. I mean, I think the elephant in the room is formulary apportionment. If you could get the whole world to agree on some kind of formulary apportionment, that would probably help, although Roseanne Altshuler and others have written articles recently saying you can game that system too, just like you can blame personal holding companies. And finally, I think the other problem that requires some help with global cooperation is tax treaties. Tax treaties were designed for the day when, if the U.S. had a tax treaty with another country, the company that got the benefit of the treaty in the other country probably paid a fair amount of tax in that country and didn't have any good ways to avoid that. Now, tax treaties with the Netherlands and a lot of countries, the fact that we have a treaty with a country doesn't mean that the company that's getting the benefit of the U.S. treaty is paying tax anywhere. It's sort of a historic anomaly that the code and a lot of the rules are written in terms of, well, if you're in a treaty country, you must be paying tax, so the U.S. doesn't care so much. That's just absolutely not true anymore. We have a treaty with Luxembourg and the Netherlands and also all sorts of countries where they get the benefit of the treaty and they don't pay tax where they are. So I think the whole treaty network system has to be redesigned somehow based on a lot of global cooperation.
Okay. Thank you very much.